The question we're going to investigate today is, are the Series I bonds still a good investment after the yield dropped by 3%? We're going to look at the pros and cons, so stay tuned for the full episode. There's been a tremendous interest in the Series I bonds, especially with inflation up. And these I bonds in the past were paying over 9% interest, but recently they dropped by 3%. So the question is, are they still a good investment now? So what exactly are the Series I bonds? Basically what you're doing, you're loaning money to the federal government and they are paying you back with semi-annual payments. The I in the Series I bonds stands for inflation. So these are most valuable, especially during times of inflation. Now, if you're considering buying Series I bonds, let's go over some basics here. The maximum that you can buy on a calendar year is $10,000 per year. You could purchase $10,000 and your spouse could buy $10,000. If you have a tax refund coming, you can apply up to $5,000 toward Series I bonds based on your tax return refund. The rate is reset every 6 months based on inflation. You set up your account at Treasury Direct. It's redeemable after 1 year, but you lose 3 months of interest if you cash out before 5 years is up. And it's best during high inflationary times, not necessarily a long-term investment. Now, what are the current Series I bonds paying? In this current semi-annual period from November 2022 to April 2023, the rate is a huge 6.89%. Now, the last semi-annual period, the rate was 9.62%. And you might ask, if interest rates are going up, why did this drop nearly 3%? Here's the latest headline regarding the interest rates increasing. The Fed approves a 0.75% point hike, the highest since 2008. The reason the Series I bonds drop so much because it's based on the previous 6 months inflation rate. We're looking at the inflation rate from October 2021 to October 2022. If you notice here, the last portion of 2022, the inflation rate, actually the growth in inflation started to drop. The Federal Reserve has a calculation that they use to determine the inflation rate that's used for the Series I bonds. So after the Federal Reserve did all their calculations, they determined that the November to April period for the Series I bonds would drop nearly 3%. Our question here, is this still a good investment? Let's take a look at the past history of the Series I bond. You can see in 2018 through about 2020, the Series I bonds yield was in the 1 to 2% range. Then inflation started to take off around 2021 and the Series I bonds yield started to increase, peaking at 9.62%. If we look over here to the right, the full 1 year rate around 2019 was 2.61%. Then inflation kicks in. 2020 was 7%, 2021 8.37%, and 2022 was 8.26%. These calculations were determined by adding the two semi-annual periods together. So in reality, the I bonds have been a good investment. If you've been investing in the Series I bonds since 2019, no doubt about it, it's been a good investment. But what's going to happen going forward? You might be surprised. So what's going to happen going forward? Most likely, inflation's going to continue to drop. We can see here the last portion of 2022 is starting to drop. What's going to happen as we go further into 2023, the inflation is going to be compared to the numbers in early 2022, and you can see they were quite high. So this factor alone is going to start to decrease the growth in the inflation rate. So even though interest rates are rising, the Fed uses the inflation rate to determine the interest and yield paid on the Series I bonds. So if that holds true, that inflation continues to drop, the next period, April to November 2023, most likely this rate's not going to be 6.89%. I'm projecting it's going to be about 3.45%. And again, that's an estimate. Now, what would be one alternative to Series I bond? You could possibly use a 12-month T-bill or a 2-year T-note, Treasury note, or even a 5-year Treasury notes. Start thinking out over a longer period of time. If the Series I bonds start to drop, they can come down quickly. And if you're thinking about fixed income over a longer period of time, you may want to think about the Treasury 2-year notes or the 5-year notes. The 2-year note right now is paying 4.42%, and the 5-year is paying 4.02 at the time of this video. So yes, the Series I bonds are paying more than Treasury notes, but let me show you what can happen real quick. We're looking at the yield over a period of time from 1998 to 2022 for the Series I bonds. You can see we peaked out at 9.62%, but we've dropped down now to 6.89%. You can see here the Series I bonds do fluctuate. They spike up, and then as inflation comes down, they come down quickly. So it's very possible if inflation continues to drop, you can see this line coming down here to the far right. It could be back down to 2 to 4% in a hurry, based on how they calculate inflation. That's why I'm saying you may want to take a look at Treasury notes, the 2-year or the 5-year, if you're thinking about fixed income over a longer period of time. Now, let me make it clear, the Series I bonds right now, they are a good investment. However, we can expect the rate to come down in the next semi-annual period. Another alternative to Series I bonds could be a certificate of depositor CD. A 3-year CD, the highest rate right now at the time of this recording is paying anywhere between 4 to 4.15%. If you're not sure you want to invest in a fixed income account right now and you want to wait just a little longer, see if rates increase a little bit more, you could get a brokerage account at Charles Schwab, Fidelity, or Vanguard paying around 3.7% right now. Let's do an example here. What if inflation continued to drop? What would you earn in 12 months? Keep in mind, if you pull your money out of a Series I bonds, you are penalized 3 months of your yield if you pull it out within the first 5 years. In this case, we're projecting or estimating that the March 2023 to November 2023 I bond yield is 3.45%. Remember, this is just an estimate or projection here. If we bought a $10,000 I bond in this period right now that we're in, November 2022 to March 23, it's yielding 6.89% annualized. Over a semi-annual basis, that's 3.45%. And then we hold that for the second 6-month period of March 2023 to October 2023. And we're projecting the yield to be 3.45%. So half of that is 1.73. And half of the 6.89 is 3.45. We're going to add that together. That's 5.18% for total yield for 1 year. That would mean $518 total earnings for 1 year. But then, let's say you decide to cash out after the first year. If you cash out of your Series I bonds between your first and your 5th year, you lose 3 months of interest. So in this case, your total interest for a year was $518. The cash out penalty is $86. So you're going to collect $422 for your 1 year of holding your Series I bond. Let's compare this to our 2-year note. Your 2-year note, your first year, you're going to collect $391, and the second year, you're going to collect $391. The thing is, in the second year, you don't know what your Series I bond is going to drop to. Inflation could continue to drop, and the Series I bonds continue to drop in the yield that it pays. If you had a 5-year Treasury note, that's going to pay $279 your first year. Again, the Series I bond is going to be a better yield. It's going to have a better payout that first year. But down the road, years 2 through 4, the 5-year could have a higher payout than your Series I bond. So who should buy I bonds? An investor that's looking for a higher yield during inflationary times. Also an investor that wants to diversify their fixed income portfolio. Who should not invest in I bonds? If inflation drops In non-inflationary times, higher returns can be achieved in the stock market. Also, an investor that is looking for growth in the stock market may want to stay invested in the stock market. An investor that is building a dividend growth portfolio is going to be better off in the stock market by investing in dividend producing stocks or ETF funds. So a person that may need to withdraw from their savings at any moment may not want to invest in an I bond. So the answer to our question here, are Series I bonds a good investment now? Yes, they are. If you've been involved and been invested in the Series I bonds over the last couple of years, without a doubt, they've been a huge return on the Series I bonds. However, if you're just now investing, looking out in the future, if inflation does drop, there may be some options that give you a higher and longer high yield fixed income return in the future. Thanks for watching this segment. Are Series I bonds a good investment now?